Great. Thank you very much. I appreciate the opportunity to be here today, everyone, and I want to thank you for spending a little bit of your time with me today. I'm going to talk about the art of trading, how to simplify your trading and grow bigger profits. Now, Options Moneymaker, we have really three different levels of programs. I'm not here to really sell you a program. I'm going to tell you about an offer at the end of my presentation, but I'm here to teach you something today. But what I'm going to teach you today is really geared for either new options traders, people who have not really traded options or maybe not traded options successfully before. I'm going to give you a place you can start. I'm going to give you a starting point because a lot of people will read about trading options, a lot of people will attend seminars and webinars, but you really need to find a way to get yourself started, and I'm going to help you with that today. We do have mid-range level programs, and we teach people who want to learn advanced options trading strategies, and then we also have a very active live trading room. So let me go ahead and get going here. So I spent 26 years as an executive, as Renee said. Throughout that time, although I really loved what I had a strong desire for lifestyle freedom, and I came to realize early on as I was just starting to dabble with trading, because I traded futures and commodities and stocks and started trading options, I realized that this could eventually lead to an entirely different approach to living my life, and that's ultimately what happened. I traded for 20 years as a hobby, loved what I was doing. The last few years I was trading, I was making way more than I was in my job, and I was reasonably well compensated in my job. And I've spent the last 10 years teaching others how to do the same thing. I founded Options Moneymaker in 2009 to kind of formalize that teaching the art of trading, and I'm a very active trader. I'm not just teaching something that I might have done 5 years ago or 10 years ago. I'm teaching every single day based on what is occurring in the markets every single day. I, along with my team of traders, host a live trading room every single day. So I'm not going to be talking about that too much today, but if any of you are interested in maybe looking into a live trading room, I think we run a great trading room. It's all fully transparent. We're trading a live account. You get to watch every trade come in, every trade that we win on, every trade that we lose on, and you get to see everything that's going on and hear a tremendous amount of interaction and discussion on every single trade. Ultimately, I was able to achieve my desire for lifestyle freedom thanks to being a trader. I get to live where I want to, I get to travel where I want to, I get to stay for how long I want to, and pretty much have complete control over those types of things that are typically limitations for people who have a job or own a business. And if you have a desire to do something more or different, if you have a desire to trade and you're looking for a way to get started, I want you to understand that what I'm going to share with you today is a way to get started on a very, very simple basis. Okay? We do far more than this, but I like to see people get started and feel confident and build their knowledge first at a simple level and then advance from there. So I'm going to talk a little bit today about stuff that would be relevant to beginning traders who might be looking for a way to get started. If you understand the basics of options, basic characteristics of options, this is for you. If you're an experienced trader, but maybe you've gotten bogged down a little bit, you're not happy with your level of success, you'd like to learn how to earn more and do it more simply, this is also for you. Of course, I'm a big fan of learning lifelong skills, things that we can carry with us throughout our entire lifetime, and it's stuff that's knowledge-based that can never really be taken away from you. Jobs can be taken away unexpectedly. Businesses can be subjected to unexpected negative impacts. But if you have knowledge and you've been wise and you have just even a small amount of money, trading is something that can really get you moving again and generating income. And I'm going to show you here in just a little bit how little you can really start with. I'm not a big fan of coming in and betting the farm. I'm not a big fan of opening up an account and putting a huge amount of money in and then trading that. I'm not even a big fan of asking, what percentage of my total capital should I put in? I'm going to give you a little different spin on that, but I'll do that right at the end here. So if you're just seeking a way to maybe learn how to trade, learn how to earn a bit more, and also minimize the natural fear that is so commonly associated with trading and trading options, I want to help you with that, and I want to help you grow a bigger account. I am going to be talking about credit spreads today. Now, credit spreads is just one method that we use at Options Moneymaker, but it's a great place for people to start. That's my opinion. You can trade credit spreads, you can trade debit spreads, you can trade calendar spreads, diagonal spreads, market tamer spreads. You can trade all sorts of different types of spreads. Options are very flexible, and when you understand that flexibility, there's a tremendous amount of earning potential in being able to trade options. But you got to start somewhere. So I equate learning, but learning actually how to do it with, let's just say, like I did several years ago, you decided you wanted to go to flight school, and you just decided, well, I don't want a flight instructor. I'm going to, read as many books as I can over a couple-week period on how to fly, on aerodynamics, on how to take off, and how to properly land and all those things. And then I'm just going to go out and put myself in the seat of a Cessna 172, and I'm going to fly because I read about it. I know what I need to do. Well, that's not practical. And when you put it in terms of learning to fly, you don't have that flight instructor sitting next to you when you take off. You might take off successfully, like so many options traders do, but generally you're not going to land successfully because you don't really know what you're doing. Options trading is very much like that. It's something that you need to make a commitment to learning. Develop your knowledge, develop your education. Now, credit spreads are a very, very simple way to start. It's a simple directional strategy. Unfortunately, although it's simple, a lot of traders fail trading credit spreads. A lot of traders fail. And I've trained and worked with thousands of traders over the last 10 years. I've had as many as 500 in a single live seminar asking me questions about how do I succeed trading credit spreads. And the benefit for me in having all those conversations, those personal conversations, was I really understood why so many people fail, and I've structured my programs to try to alleviate that. It's really about improper selection of strikes. It's about not building enough time into your position. There's a gross naive assessment of risk where a lot of traders will put on way too much risk without even realizing they have the risk in play until it's too late. And one big one for me is they don't really know how to properly adjust or manage a position. And that knowledge all by itself is going to significantly improve your success. So those are the types of things that we are going to focus on. I'm going to talk a little bit about this thing called the forgiveness factor. That's a term we use here at Options Moneymaker. How to trade spreads with a minimal true risk using a forgiveness factor and time. How to properly select strikes and expirations. How to adjust a trade. I'm going to give you some examples. I'm going to give you 3 examples of trades kind of leading up from building a credit spread all the way into managing a position. So let me start with the forgiveness factor. There's a lot of confusion and a lot of differences of opinion amongst traders as to how to choose the right strikes. Where are you going to place your strikes? Where are you actually going to place the risk that you decide to place in the market? How are you going to decide that? Well, we like to build what we call a forgiveness factor into our trades. Forgiveness factor is essentially when you're trading a credit spread, which is a directionally biased position, it's essentially saying that the stock or the index or the equity that you're trading has moved against your position, but you actually still have an opportunity to make a profit. It's all about putting natural barriers between the current price and your risk strike, that strike that you don't want the equity to move past. It's basically about being wrong on the direction or the timing and still winning. Now, I'm a huge fan of studying charts, but charts are also something that can be overly complex if you don't know where to begin. So I'm going to show you here in just a few minutes that we also promote a very, very simple starting point for charting. I believe that you should build a strong foundation in your knowledge of strategies, your knowledge of charting, and then you can build from there depending on what your personal appetite is. So a credit spread, for those of you who may not be completely familiar with a credit spread, I'm assuming the majority of you are, but I'm just going to very quickly construct a credit spread here for you and define some of the guidelines that we follow and teach at Options Moneymaker. So we decided to put a credit spread on NDX. Now NDX is one of 3 indexes that we like to trade: NASDAQ 100, S&P 500, and the Russell 2000. We trade those primarily in our entry-level program, and the reason we do is because it keeps our focus on just 3 specific charts, 3 specific equities that we can trade. That simplifies our trading. We're not constantly scouring the entire universe of optionable stocks for the next best trade. We're going to zero in on and become intimately familiar with these 3 indexes. So we built a trade on NDX because there was a declining bias. We decided to open a call credit spread. A call credit spread is going to be how you're going to benefit from a declining bias. We sold to open a 45.95 call. We sold to open a 45.95 call and bought to open a 4600 call. Now that has a 5-point spread to it, which means that your maximum risk is going to be 5 points. We took $1.60 of credit when we opened this, so our actual net risk is $3.40. And it's the net risk of $3.40, the maximum amount I could potentially lose on a per share basis, that I'm going to use to decide how many contracts I want to trade. But the 45.95 was not just purely an arbitrary placement of our strike. It's 65 points out of the money. Now we want the index to move down, or at a minimum we want it to be trading below 45.95 when we get to expiration. But if it moved up instead, what we've done is we've allowed ourselves this room of 65 points for it to move, and we could still be profitable on this trade. Now 65 points is not a fixed number. Every trade is not 65 points, and I'm going to show you a chart here in just a minute and give you a couple of key factors that we used that you're going to see how simple it was to choose where to place our strike. But before we get to that, I also want to show you that in the first week of May is when we were choosing this trade, and we decided to use a May week 3 expiration. We generally don't trade the following week. We definitely don't trade the near week, the current week. We're generally going to use an expiration that is 2 to 4 weeks further out than today. The reason we want time built into our trade is because if we have to manage or adjust the trade, we want plenty of time to maintain control over our trade. We want to be in control of the decisions that we make. We don't want the market to force us into a decision, and it's the difference, folks, between responding to a need that a position has versus reacting. We intend to respond on every trade. We might spend a day or 2 assessing what it needs and then make an adjustment. We don't want to have to react and be forced into doing something. So a couple of the factors that we considered in choosing this trade are NDX at the time had hit the highest high in 15 years of 45.62. We placed our risk strike 33 points higher than that. Why is that important? Because we know from experience, and I know from trading for over 30 years, that when the indexes start to approach all-time highs or multi-year highs, they tend to start hitting a stronger headwind. It slows things down a little bit. It doesn't guarantee that the price is not going to move above that. I'm not saying that. It just says that it's one of the cards that's stacked in our favor in our deck. We're trying to stack the deck in our favor. It's 1 point. And the other one is an even stronger point. We use 2 and 3 standard deviation Bollinger Bands on our chart. And it's actually the only technical indicator we use, especially for people who are just starting out learning how to trade options and read charts. And we know that the price will move back and forth between the upper and the lower Bollinger Bands, but when the price exceeds the 2nd deviation or the 3rd deviation Bollinger Band, the price has a high probability of reversing and moving in the opposite direction in a reasonably short time period. So we placed our risk strike 15 points higher than the 3 standard deviation Bollinger Band, knowing that if it got all the way up to our risk strike, it would have such an extreme pattern interrupt of the Bollinger Band that it was likely that it would move lower. So let's take a look at a chart just to get a quick visual on this. Here's where we placed our risk strike, 45.95. Here's where NDX had hit a new high, 15-year high, so we had to get above that. We were also in a declining pattern at the time, so we had to move above a declining level of resistance. And here were the 2 and 3 standard deviation Bollinger Bands. And so we knew that in order to intrude on our risk strike and put this spread at risk, we would need to move above both of those Bollinger Bands. And you can just go back and look at this chart or look at any of your own charts, and you'll see the number of times that the index moves back and forth between the Bollinger Bands. This was a solid trade here, solid trade placement. And that's really how simple this can be, folks. It doesn't have to be complicated. This trade uses time. We had 2.5 weeks to expiration. It has a forgiveness factor of 65 points. But more than the 65-point forgiveness factor, we have multiple roadblocks, multiple barriers between the current price and our risk strike. And you can choose a trade like that just simply by looking at a chart with Bollinger Bands on it. And you can place your risk strike outside of the upper or lower Bollinger Bands depending on which directional bias you're seeing in that trade. We also automate our trades. We try to keep everything as simple as possible, especially when we're starting out. Now, we have more complex strategies that we use. We have more involved trades. But I'm talking right now about a method for getting started, for people who really want to immerse themselves in learning how to trade options and do so successfully. So we automate the close of our trades too. Once a trade has been opened, we want to close it for about a 10% return. Now, the 10% line is something we use. You certainly can use whatever you choose, whatever makes you happy, but 10% is a good guideline for us. And so that's 10% of the spread, of the total gross risk on the spread. So there's 5 points of gross risk on the spread. That means we'd be looking for a 50-cent profit, and maybe we're trading 5 contracts, maybe we're trading 10 contracts, whatever that is. So each contract is 100 shares. So that's the type of profit we're looking for. And then what we want to do is to take that capital and recycle it multiple times. It's the recycling of capital over and over again, using the same base capital to generate profits, that allows someone to exponentially grow their options trading account. It's not because you took a huge risk on one trade and got lucky. There are some people that will do that, but that's not the right way to trade options. This is all about winning the game on base hits, multiple base hits, many times over. And you can accomplish this type of trading in just, say, 30 minutes a day. Enough time to look at your charts. We're going to limit you to 3 charts. You can trade more. You can trade stocks too. You can trade ETFs. We generally limit our view as we're starting out with new traders to NDX, or SPX, and RUT, just those 3 indexes. So you've got 3 charts to look at. You're looking for new trades. You're done with that after a few minutes because it's so easy to spot. And then you're reviewing your existing positions to decide whether or not there's any action that needs to be taken. And I'm going to give you 3 questions to ask on each of those positions here in just a minute that will help define for you whether or not you actually need to take any action. Now, the cool thing about a credit spread is it can also be constructed as a non-directional position, and if you follow the guidelines that we're sharing here, that I'm sharing, you can be very successful in trading a non-directional strategy called an iron condor. An iron condor is essentially just opening a call credit spread and a put credit spread at the same time. Now, you don't have to be as good at charting. I wouldn't say it eliminates the complete need to look at your chart, but if you're not confident with your interpretation of the charting, start out with iron condors. You've got a profit potential regardless of which direction the price moves. one side of that iron condor, either the call spread or the put spread, is going to win on the move, whatever move it is, and the other side, if it's been constructed properly, has the potential of winning based on the forgiveness factor. So if you can construct iron condors properly, you can win regardless of which direction the index moves. Using Bollinger Bands as a very simple guide for constructing your iron condors is an excellent way to trade, especially if you're using the indexes. Now, as clarification, when I'm talking about these indexes, I'm not talking about futures. I'm not talking about the ETFs like the Qs, SPY, or IWM. I'm talking about trading options on these indexes. That's what we've really focused our attention on for the last several years, and it works very well, folks. The spreads between bid and ask are very wide on these, and that puts some people off. I'll just tell you, we teach you how to overcome that. There's a very, very simple way to overcome what appears to be a wide spread and actually turn it into an advantage for you. But these are excellent for trading iron condors. Both sides can be opened at the same time, or you can leg into each side as the index cycles. One of the things I can guarantee on these indexes, and it's probably the only thing I can ever say with absolute 100% certainty about trading, is that indexes cycle. If you see a rising cycle on SPX, guaranteed following the completion of that rising cycle, there's going to be a declining cycle. Now the trick is trying to determine when that next cycle is going to start. But I can guarantee you that on each of these indexes, and on most stocks too, a rising cycle is going to be followed by a declining cycle and vice versa. So if you learn how to play those cycles and you use a very simple strategy such as credit spreads, it's an excellent way for you to learn how to grab profits. All right, let me give you example number 2 of 3 that I'm going to give you here. This is a trade where we legged into an iron condor on RUT. It didn't start out as an iron condor. It actually started out as a call spread, a call credit spread. RUT was trading at 1260 at the time. We placed our strike, our risk strike, at 1280 and opened at 1280, 1285 call credit spread. It was about 2.5 weeks to expiration, so we had about 20 points of forgiveness factor built into the trade. Took $1.40 a credit on that. The next day, we actually had an opportunity to close out of that call and take a profit. We paid back 80 cents of the original $1.40 that we took in, so we kept a 60-cent profit, and 60 cents divided by the $5 of gross spread risk is a 12% return. That same day, after we closed out of the call spread, we immediately recycled our capital. We had taken all of our capital back. We're back to cash now, so we immediately recycled our capital. The index had moved lower down to about 1250, and so we saw on the chart, and I'm going to show you the chart here in just a minute, but we saw on the chart that it was highly likely that the index was probably going to cycle back higher. And so what we did was we closed our call spread, took a profit, and we immediately opened a put spread. Still have 2.5 weeks to expiration, use the same expiration, and we placed it such that we had about 20 points of forgiveness factor. Index was trading at 1250, our risk strike was 1230. Took $1.12 of credit. So we're right back into an opportunity trade here, and we've recycled our capital, already taking a 12% return on that capital. This was kind of an interesting opportunity. This happens periodically, that's why I'm using this trade as an example. Later that same day, the index actually did cycle higher, offering us an opportunity to reopen the same call spread we had just closed earlier in the day. At this point in time now, we hold an iron condor. We hold both the put spread and the call spread. And here's just 30 seconds of the significance of that, folks. You've got 5 points of gross spread risk on a credit spread when you have 5-point difference between the strikes. There's 5-point difference here. There's also 5-point difference on the calls. But because we know, your broker knows, everybody knows, that you cannot possibly lose on both the puts and the calls at the same time, they only allocate 5 points of spread risk on one 5 points of spread risk on an iron condor, which means that you are doubling up on the credit. So when I took a credit of $1.12 on 5 points of spread risk, I had $3.88 of risk. Now that I've added another $1.30 of credit, I have $2.42 of credit against 5 points of spread risk. So I only have $2.58 of risk. So trading iron condors can dramatically lower your risk. And no matter what strategy you're trading, no matter how you want to learn or who you learn from, absolutely, folks, the very, very first thing you should ever focus on before you ever choose a position or look at a chart is how much risk am I willing to put into the market in order to generate profits. This is a game about managing your risk. If you don't manage your risk, it doesn't matter how great your strategy is, you're just not going to succeed. The next day, we actually had an opportunity to buy back the puts. Okay, so now we're into just holding a call spread. We're out of the iron condor, but now we've taken another profit, 52 cents, difference between our $1.12 and the 60 cents here. And then a week later, we closed out of the calls. So a quick summary of that trade is we were in it for 9 calendar days, 7 trading days. We took just over $1,000 of profit. That was $2 of total accumulated profit on that one chunk of capital, and we were trading 5 contracts, which is equivalent to 500 shares. So if you take that $2.02 divided by the 5 points of spread risk, it's just over a 40% return. The 40% return, if you told your neighbor, your dentist, your brother, hey, I made 40% in the market, they're going to look at you like, why are you taking all that risk? What are you doing? I mean, that's crazy. You're going to lose a whole bunch of money, and it's because they don't really comprehend how the whole recycling of capital is such a positive impact on being able to exponentially increase the value of your account. This is all about opening and closing trades on the cycles and recycling your capital for bigger returns on the same capital. So here's a quick visual of where we open those. We opened the call spread originally up here when it was trading up at the upper Bollinger Band. We bought to close the call spread when it moved down and traded below the lower Bollinger Band because that pattern indicator right there tells us that likely it's going to move higher. We also opened the put spread because we thought it was going to move higher. That's exactly what it did. Then we opened the call spread again, continued to move higher. We bought to close the put, and then we waited a week to close the call. If you're using a simple approach to start out with, use Bollinger Bands. If you want a simple strategy to start out with, use credit spreads. If you aren't sure about your ability to look at the charts properly, use iron condors. Now, real quick, I want to give you one last example of managing a position because you can have great forgiveness factor built in. You can have plenty of time built into your position. You did a great job of interpreting what was going on the chart and looking at things relative to your Bollinger Bands, but the reality is the market is the market. We always want what we want what the market wants. That's what we should want. And sometimes the market shifts gears unexpectedly, so we might need to manage a position. So if you've found yourself needing to manage a credit spread, there are really 3 very simple ways to do it, and these are the most common ways that we will adjust credit spreads in our accounts. We'll roll it out because we want to add more time to the position. Options have a limited lifespan to them. We're going to run out of time, so we want to roll it out and add more time. We do that when we believe that the position is still set up to win. If the index, our price has moved above our risk strike in a call spread or below our risk strike in a put, we want to move the strikes and put them out of the money again, so we're going to reposition. And then there are situations where you might need to do both. A lot of people get really nervous because they believe it takes a tremendous amount of capital to make these types of adjustments. It doesn't. It's a small amount of additional capital you're going to commit to the trade in order to be able to manage it. It's kind of like owning a rental property. You're getting your rents all the time, and you've got your opportunity there, and then you need to fix something. You got to put a little bit of money into it in order to continue being able to leverage the opportunity. Now, the question is, how do I know when to take a trade? How do I know when to take a trade? Well, I'm sorry, when to make an adjustment. Well, I'm going to give you 3 very simple questions that you can start using today with your trading. Okay? 3 very simple questions, and the reason we use these questions, although they seem a little overly simplistic, is because by using these guidelines, these questions, it eliminates the need for you to rely on your emotions. Your emotions are going to fluctuate from day to day depending on what you've heard in the news, financial media is saying this, what your feelings are about the trade, what you think is going to happen. Forget all that. Let's first of all determine, do I have a profit in the trade? If the answer is no, I'm done. Do I have my risk strike in the money? Is the leg that I sold to open on my credit spread in the money? If the answer is no, I'm good. I'm leaving the position alone. Is my expiration less than 1 week away? Am I starting to run out of time? If the answer is no, I don't really care if you have a drawdown on the position. I don't really care if you think that the index is moving strongly towards your risk strike. There's no reason to take action right now. We've just eliminated the emotion out of the equation. No profit, no action. Risk strike is still out of the money, no action. Expiration still has more than a week, no action. Leave the position alone and use the management technique that we refer to as patience. Now, if you have a profit, it's entirely up to you as a trader to decide whether or not it's a profit that you want to take. I use 10% as a guideline. If the risk strike is in the money, you're going to do a reposition. It's the first clue that you want to do a reposition. And if your expiration is less than 1 week away, it's the first hint that you might want to do a rollout of that position. So let me give you a quick example of a trade that we did that started out as an iron condor, and we ended up having to manage it. So it started out as an iron condor. We had a call credit spread and a put credit spread. We had 2.5 weeks to expiration. We had a 65-point forgiveness factor on the calls, and we had an 80-point forgiveness factor on the puts. And again, after I walk through this, I'm going to show you the chart. This is the last example that I'm giving you here. So we start out with that iron condor. We take $1.66 of credit on the calls, $1.17. So we've got $2.83 of credit against only 5 points of spread risk. Right now we don't have a tremendous amount of risk in the trade, but we've got a lot of opportunity. A couple days later, we had an opportunity to close the calls. There was a movement lower of the index, and we had an opportunity to close the calls and lock in a profit. We paid back 65 cents of the $1.66 we originally took in. A few days after that, we had an opportunity to reopen a call spread, but because of where the index was trading, we opened a different set of strikes. We still used the same week 3 expiration, because in order to have an iron condor, both sides of the trade need to have the same expiration, both sides need to have the same spread width between the short and the long leg, and both sides need to have the same number of contracts. So we dropped our strikes lower, and we took in $1.50 of credit. A few days after that, we closed the puts. So folks, this is all about the cycles and the movements and using them as an opportunity to take profits on one side and jump out of an iron condor and then get right back into an iron condor and take profits on the other side. Now, a couple days after that, the index moved above the strike of our call spread, our new call spread. And we felt like we were starting to run out of time. We actually felt that, based on our view of the chart, that the index was going to cycle back lower again, but we wanted to make sure that we didn't run out of time before we had an opportunity to take advantage of that. So the way we managed that is we just simply did a rollout. And a rollout is taking our current call credit spread and all on one order ticket, 4 legs on one order ticket, buying to close the April call and selling to open simultaneously the May week 3 call. So basically we rolled out 4 weeks. Now we had to pay $3.40 to close the April call, but we took in a credit of $3.20 to open the May call, and so that management move cost us 20 cents. We had some transaction costs in there too, but we measure all of our performance, which I'll get to here in just a moment, based on net after fees and commissions. So it cost us 20 cents for the right to have an extra week to expiration. That's, in my book, nothing. That's nothing for the opportunity that we have. It also doesn't change the status of our position, other than adding 4 more weeks. We had a drawdown at $3.40, meaning if we had closed and abandoned the position at that time, we would have locked in a loss, but we still have the same drawdown. We rolled it out to May week 3. It's just that now we've got more time to recover it. And then a week later, after that, as we would have been running right up against April expiration, we had an opportunity to close the May week 3 calls and take an overall profit. So we were in this trade for 14 days, 18 calendar days. We ended up making $468 in total, even though we had to manage the trade. And it was about a 15.5% return on a 5-point spread, 5 points of spread risk. Once again, it's all about opening and closing on the cycles and then managing rather than worrying. If the first thing you do when you see that a position is in trouble is you get yourself into a panic mode, you're not going to make good decisions. We would rather have you learn how to adjust positions because it's going to buy you a lot of peace of mind. And so here you go. Here's the last chart I want to show you. These show the placement of the strikes when the position was opened. This shows where we were moving below the lower Bollinger Bands, and we use that as an opportunity to buy to close the calls because that tells us that we're probably going to move higher. Here we moved higher and we opened the new calls, and we continue to move higher, and we're running out of time, so we rolled it out and waited for it to move back lower, and we closed out of the whole position. The summary of this, folks, is leverage the cycles. You can use the Bollinger Bands as a very simple starting point. If you're already familiar with and skilled in more advanced charting, if you truly do understand the advanced charting and you trust those signals, then this is an awesome strategy that you can just clean up on week after week. The approach I'm sharing with you here is great for new traders, and it's also great for people who may want to kind of reset their whole learning process about options and credit spreads. Build a forgiveness factor in each trade, build time into each trade, and just keep yourself out of that roller coaster fear and anxiety trading mode. This is really how simple I believe trading can be. So let me just give you 2 minutes of the program that starts people headed in the direction of what I just shared. It's called our Profit Builder program. It's where we want you to learn to build your knowledge of trading options. And it's all about teaching you how to start with just $5,000 of risk capital. Being willing to trade $5,000 and have maybe 2, 3, or 4 positions open at a time, and learning how to recycle your capital and compound those profits. So we introduced the Profit Builder program for newer traders in 2015, and we started with $5,000 of risk capital. Now, it was a personal account of mine. I actually had $11,000 in the account, and I just left the $11,000 in there, but we risked $5,000. That's how much we were willing to risk. And then we just turned our capital over and over multiple times. We have losing trades, we had losing months, but over the first year, 12 months, we earned $14,317 of profits. So that's a 286% return on that initial risk of $5,000. And this is what we teach. I can't guarantee that we're going to do that in the second 12-month period. I can't guarantee that we're going to even make a profit. What I can commit to you is that this program is designed more about your education first and less about actually making a significant amount of money. I want you to learn how to make a significant amount of money and then do it on your own. I think it's a powerful way to start small and grow big. So this just shows you the content of the program, and I'm going to highlight two things here. Up front, you get 4 hours of on-demand videos about getting started with a program, okay? That's how you get started, and you immerse yourself in learning. Now you get a couple of PDF guides that are trader's guides to credit spreads and options basics. But the real meat of the program, folks, in my opinion, is a daily 20-minute video that we send you that is part of your ongoing continuing education. It's a daily 20-minute video. That means that whatever's going on in the market that day, however the market is affecting our current positions or looking at the charts for opportunities, you're going to learn every single day as though you have a coach standing right there with you evaluating the market. That, in my opinion, is the meat of this. Back in my old corporate days, I focused a lot of my career and attention on adult learning and the ability of people to really learn to be effective in their roles, and I've translated that into my company, and this is the way I believe people should learn. You chunk it down into small chunks that are delivered every single day that you are a subscriber. So we also send you trade alerts, email and text alerts of every trade we are placing in our account so that you can follow along if you choose to, and if you don't understand the trade, you don't take the trade, wait for the 20-minute video to come and we explain it in great detail about why we took that trade and why we think it's a good trade. So $14,000 is what we made in the first 12 months. Here's what it would take to get started. You need to be willing to risk $5,000 of capital. It's not all in one trade. It's going to be 2 to 4 trades at one time. We split it up. And it's going to cost you $195 for the first 30 days to participate. So everything that I just talked about is what you get for the first 30 days for $195. There's no obligation to continue after that, but I think the real meat of this is to continue on and receive those daily reviews and the alerts, and it's only $79.95 per month after the first 30 days. So if you're interested, sounds like something that you might want to participate in. The link is optionsmoneymaker.com, what we offer, and you'll see the sign up there for the Profit Builder program. And you can go to our website and browse around, learn a little bit more about us, take a look at our team. If you're a more advanced trader and you'd like something that's more mid-level and advanced spread strategies, we have a Profit Maker program. And then if you have full-time trading capability and have an interest in being an active trader, we have our live trading room and our Profit Accelerator program. But you can learn all about that on our website. So this really is focused on people who are looking for a way to learn and understand. So I think I have just a couple of minutes here, and let me just see if there are any questions. John asked, how does one calculate the standard deviation for 2 Bollinger Bands on each trade? John, I just let the chart do that for me. It's going to vary. It's going to vary, day by day, throughout the day. But you can just set up the Bollinger Bands on your chart, and you just need to select that. You can set it up twice on your chart and just select that one of them is going to be set as a 3 standard and one of them is going to be set as a 2 standard deviation. Barbara, and I think let me just take this question. I think I'm out of time here, Renee. Barbara says, I missed the beginning of your webinar. You trade options without using Black-Scholes model. Yeah, Barbara, we keep things as simple as possible. What we want people to focus on are the things that we know will actually help them make money. Keep it simple. There's an awful lot of advanced, complex things that people can learn about trading options that in the end will not actually help you make money. So that's our attitude towards that. We've tried to filter out all the stuff that isn't really going to contribute to you making money. And just very, very quickly, and then I'm done, John asked, what's the difference between Profit Builder and Profit Maker? Profit Builder is what I was just talking about, which is really geared towards kind of getting started with feeling confident with trading options. Profit Maker is a brand new program that we actually just introduced today. We just announced it today, and it's where you're going to learn how to trade calendar spreads and diagonal spreads and market tamers, and then you're going to learn our most advanced management technique that we use on our own trades, and we teach to our clients. So that's what the Profit Maker is.